Welcome back to the Stuff About Money They Didn't Teach You in School podcast. I am your host today, certified financial planner, Erik Garcia, and I am joined today. This has kind of become an annual tradition. I think might be number 3. I'm joined with Phil Blancato, Chief Market Strategist for Osaic. Osaic is the firm that I have chosen to partner with as a financial advisor who really provides me with a lot of the back-end support that I need to be able to serve my clients. So, Phil, welcome back to the show.
It's a pleasure to be on, buddy. I know we get to see each other from time to time, and I've always enjoyed being a part of it. So thank you for having me back.
100%, man. One of our core values here as a business is to let fun happen, right? The idea is that like fun's all around us, and we just got to get out of the way. And as I was preparing to talk with you this morning, I was thinking about last time I saw you. I think it was in September. I think we were maybe San Antonio.
Yeah.
And like literally the last time I saw you, you were on stage with the DJ, jamming out to Pink Pony Club after having just sang a song with the lead singer for American Authors.
Yeah.
So you are a man who knows how to have fun, and I'm looking.
Life is too short. There's my motto, which someone gave me, is growing old is mandatory, but growing up is optional.
Oh, let's sit there real quick. Growing old is mandatory, but growing up is optional. How does that interface? You're in a pretty serious business, right? Your work is pretty serious, right? You're managing a lot of money for a lot of people, helping people build their wealth. How do you balance this idea of fun? And you work in New York City, and kind of the image that us Southerners have of city people up there, right, are kind of like a little more stoic and rigid. How do you interject fun in your industry?
That's a great question. You're right. I oversee $800 billion under management. Directly control about $8 billion in assets, and get to be on TV all the time and quoted. I've come to realize that, first of all, nobody's that important. So you got to never take yourself too seriously. Second, I learned from my mom and dad a long time ago, Italian immigrants, that you have to realize that what matters most in life is family, friends, and then your work. And it's not that I put my work behind those, but the work is intertwined with my family and friends, and that's why it's fun for me. So my job, to be easy, the answer that rather than being that kind of stoic Wall Street person, I've succeeded in my career by saying, wait a minute, what if I make the people I work with my friends and my family? Mm-hmm. And that's why it's so fun. You're a friend. So I do take my work very seriously. I work very hard at my craft after 35 years of doing it. Luckily, knock on wood, been a darn good portfolio manager for the bulk of the time. But I think it's because I've never worked a day in my life. I really enjoy what I do. So when I say growing up is optional, I still have fun skiing with friends and family. I love to eat and make big dinners with friends and family. A lot of financial advisors that are dear friends of mine, that we enjoy life and the benefits it can bring. But I happen to be one of the lucky people that my job is very fulfilling for me, and I do love it. So I get a lot of fun out of the job as well.
I got a business mentor of mine who always says, your work should be your passion, or your work should fund your passion. And man, what a blessing it is when your work is your passion. Because I feel exactly the same way you do, man. I love having these conversations. I love meeting with clients. I love helping clients make good decisions with their money. I love keeping clients invested in the stock market, even when it's crazy, knowing that it's best for them long term. So that's what you're here to talk about today. You're here to talk about the stock market. I mean, we should do a show just on family and fun and friends, not even talk about money. That'd be fun. But
you and you're lucky enough to do something cool. We get to make 1 and 1 equal 3, and we make people's lives better for it. And I just think that's a blessing. I really do. I've been very lucky to do this for a long time.
So I do want to get to your 2026. I know we're kind of 2 months in already, and you might have a little bit of maybe your 2026 kind of thoughts or insights may have changed already with what's happening. Maybe not. I want to get to those. Before we do that, I kind of want to start backwards, right? You go on these podcasts, they always end, not always, but sometimes like the lightning round is always in the end. On like game shows, it's always the lightning round, all right? So we're going to do a lightning round, and then you'll have the opportunity to expound on your responses kind of as we, as the podcast episodes unfold. So the temptation is to give all kinds of defense for why you picked one answer or the other, but this is the lightning round, Phil. We don't have time for that, okay?
I like it.
All right. Small caps or mega caps?
Small caps.
Always. U.S. or international?
Both. Sorry.
Both. Okay.
But in fairness, mostly U.S., but a portion international.
U.S. I'm sorry. Commodities or crypto?
Ooh, commodities, easy one.
Yeah, I figured that one. Rate cuts or no cuts?
Rate cuts,
Rate
1 to
cuts.
2.
Yeah. What's the most overrated asset class right now?
Gold.
Most underrated.
Ooh, most underrated asset class. Market's been pretty hot for a long time. I'd
Yeah.
say this is going to be a weird one. Emerging market debt comes with
Ooh.
lots of volatility, but you
Ooh.
got a wonderful yield. And if EM does what I think it's going to do, it'd be a pretty good place to do.
Yeah,
Be.
you went to a corner right there on that one.
Yeah.
Hard landing, soft landing, no landing.
No landing at all.
No landing.
But caveat, one correction of 10% this year,
Off
if not
10%.
12.
Okay. When do we see that? First quarter, second quarter, third quarter, fourth quarter?
Summer,
Summer.
July.
Okay.
Yep.
If markets were a pasta dish, what would they be? Oh, man.
That's a great question. They'd be lasagna.
Lasagna.
Lots of layers, each one with a little bit of different flavor, but in the end, tastes really good.
And a good lasagna is complicated. The flavors are complicated, right?
Exactly.
Yeah,
Exactly.
yeah. All right. And why is Italian pasta superior to American made pasta, Phil?
It's easy. Next time you go to the store, please take my advice.
I did already.
If you can look at the ingredients on what's imported from Italy versus whatever brand you buy, you'll see that one of the American brand is loaded with different ingredients. The Italian brand will have maybe 2, upside 3. It's going to be semolina, water, and maybe a different type of flour. But that's why you want no ingredients. You want clean pasta. Takes longer to cook, tastes a lot better, and always al dente, not soft.
Awesome. All right, lightning round's over. That was fun. Now you can kind of give your reasoning as we kind of talk more here. But as we start off, like if there was one headline for 2026 that you could kind of summarize, what would it? And I know you just said it's a lasagna. It's complicated, but one headline.
The return back to normal returns of markets.
Now, when you say back, when I hear like normal returns of markets, one of the first thing that comes to mind for me is maybe more market breadth, where like there's more participation more broadly across the markets. Is that something when you talk about
That's
normalcy?
predominantly what I meant, and secondarily, average S&P 500 returns of 8%, maybe 6%, versus what we've come accustomed to the last 10 years of 14, 12%. Those are unusual. They shouldn't be happening unless there's some stimulus making it happen, whether it's AI or government spending. But reality is folks are going to have to get accustomed to going back to normal returns of the S&P. But with your point, which is an excellent one, in order to have a good portfolio, you're going to have to be in a lot of different markets, not just AI.
So let's start there, because I know that AI is hot. There's always, it seems to dominate a lot of conversations with clients. They're asking about it. They want to jump on the AI trend. We're talking about tech companies are spending massive amounts in AI right now, and the level of revenue that we would need some of these companies to generate it's just kind of mind-boggling. Are we seeing just a slowdown in the AI race, or what's kind of happening there? Talk to us there.
Well, one of our forecasts for this year is it's a defining year for AI. In other words, what companies can either continue to grow revenue or use AI to be more productive. I'll give you 2 easy examples. One, just recently, and when you think about what NVIDIA is doing, generating around $60 billion a quarter in just pure revenue. These are numbers that are incredible. You could take most of the S&P 500, roll them together, and they don't match the kind of revenue that they're producing. And go one further, the CEO of NVIDIA came out to say, in the not too distant future, 5 years out, every single time you access anything that's computer related will have an AI interface in it. And we're kind of already there. So think about your whole world being defined by AI, every single piece of technology, and then every day you're going to touch on that. Well, what does that mean? You need a lot more computers, you need a lot more hard drives, you need a lot more software, and certainly a lot more data storage. But my point is, who are the winners and losers in that race? Is it Corning, a company that I love, trading at an all-time high? Now, I'm not suggesting you go and buy it, but the reason I mentioned it, they make fiber optic cables in data centers, the best in the world. NVIDIA, with their ability to create software that makes the data center come together. So when I'd say a defining year, you define it by who is actually becoming more productive in making money, whether it's Caterpillar, because they make tractors that are going to drive themselves and create power generators that will power a data center. Is it Corning or is it NVIDIA? But it's also the companies that are going to get disrupted. So defining it, what companies, Adobe, a really good company we all use every single day, there's a good chance it gets so disrupted, you see the revenue cut in half because AI bots will be able to do what Adobe does for maybe free. So I think that definition around it, and when I say looking at it, it's understanding that in order to succeed in markets, you're going to want an active piece of your portfolio in bonds. Why? Because they're sexy again. They can get you a nice 4 to 5% yield. You want to be in other areas that have become more productive because of AI. Small caps, why I like them, they're cheaper than large cap, 46% cheaper. Then it goes one step further. What if you ran the local deli and suddenly the guy slicing your meats for your sandwiches every day who didn't show up for work is now done by an AI arm, which is actually happening. And suddenly you're not paying benefits to that arm and they're not calling in sick and it slices a perfect piece of meat every day. Well, that's real productivity. And we're starting to see some of those gains happen. So that's why I think being diversified will help weather volatility. It'll help give you access to other markets that are still just beginning to benefit from AI. And most importantly, it gets you away from owning 7 stocks that they're not doing nearly as well this year as they have in the past.
We're going to come back to bonds being sexy because that's actually in my. I actually have that in my notes to come back to. But let's stick with AI for a second here, and you bring up a couple really interesting points. When we think of AI, NVIDIA is kind of one of the names that pops in the mind. We think of like the chip makers, right? The people who are powering some of the hardware to allow us to be able to use AI. I remember you hosted a fireside chat at some point last year, and you had 3 energy companies on the stage, right? And it was just an interesting conversation to listen into because these are the guys who are either responsible for generating the electricity or getting the electricity from the power plant to businesses and industry and whatnot. And in large part, historically, energy is not a sexy kind of stock to invest. Consistent, but like listening in, like these are now like, oh my gosh, the utility companies are almost like they're growthy. It's interesting. And you talk about like the NVIDIA, but then you talk about these other, support industries. Have we moved on from the companies that come to mind as the AI companies? Have we moved on from that to now the companies that are going to benefit from the use of AI are going to start to come, online a little bit more in terms of returns?
And that's exactly the point. For example, think of how many companies today are in the business of generating power. It used to be just boring utilities. But in the world where power creation is going to fundamentally ramp up in a way we've never seen in human history. For example, if all of us switched to driving electric cars tomorrow, we would need to mine more copper than ever mined in human history. We would need more power than ever created in human history. So who's going to benefit from that? Whether it's the southern companies of the world, which is a great power company in the southern United States. Now, again, not suggesting you buy them, just talk about a great company, but a company that I think is in the forefront of creating new power for this demand. With AI as the hub, what are the spokes that are going to be part of creating that powerful wheel? And it's whether it's a power company, the company's finding the materials, or back to kind of that simplest of analogy for you is taking advantage of it. Where is growth? And growth in and of itself is going to be in not just power generation, but the enhancement of productivity because of AI. And you think about the fourth quarter of last year, we saw 5% productivity growth in the United States, one of the highest numbers we've seen in a decade. And I'll give you another example. My friend Flippy the Fryer, which I'd love to talk about. If you walked into a White Castle, which is a cheesy burger chain on the East Coast, they make terrible sandwiches, but the kind of place people go to when they've had a rough night because they're a little greasy. I have an arm that fries French fries. It's an AI arm. And that arm last year did 200,000 man hours and 5 million baskets of French fries. That arm never called in sick, didn't pay any benefits. It certainly was very effective in frying the perfect French fry. That's an example of productivity enhancement that we really can't wrap our head around yet what it does for earnings. Companies will either earn more or pay their employees more or be more efficient because of AI. And that's going to be the fun part, watching this efficiency explode around the globe, and especially in the United States.
Yeah. So can we think about that? Like, you're talking about disruption in like Adobe being disrupted, and some of the software companies. Like, what do you when you think about the AI trade, so to speak, right? In all the industries that it touches, are you just generally, are you more of the hardware infrastructure leaning, or like the software leaning? It seems like the software has the most space for disruption, which seems there's the most potential for volatility, as opposed to like on the hardware side.
Some of it lately, and I don't want to be too pertinent to the last few days, but some of the old saying of the baby's getting thrown out with the bathwater. And the reason why we're saying that, a company like Workday, which is a solid company, it's all over the globe. It's in the United States. You're watching their stock just get decimated. I cannot recommend you buy it. But when you look at the strength of the company and the revenue they create, certainly you look at a company that was trading at a 35 PE ratio a year ago, now trading at 12. There's these opportunities that have been created by this software destruction that, whether it's Anthropic or some of the other AI large language models might do, but we're a ways away from that. If you don't want to play in that, and I would say I'm always been a big fan of why people like me are successful, or Eric, or whatever we look at, we take advantage of when there's a panic in markets. And there's a panic in the software market right now. What does it mean? I think you could actually buy some really good companies a lot cheaper. But to your question, I think the real answer is, if I have a core concentration in AI in my portfolio already, I would bet most people already own some piece of it.
Mm-hmm.
Where don't I have exposure? And that's where I think you want to take advantage, whether it's small caps or mid caps or international companies that are just beginning to use it to be more productive. And to your point, it's in the power. It's in the company creating the cables. It's in the person creating the data center, building the materials that go in there, like Corning. And where can you take advantage of that, I think, is the next step of the success.
Yeah.
Mid-cap stocks are famously part of that. That's an area where I think you might want to think about.
Yeah. It kind of feels like the traditional, when I say traditional AI trade, the names that pop in mind,
Right.
the Magnificent Seven, you kind of get a sense that a lot of those companies are a little bit over their skis. Not that they're bad companies, you probably still want exposure there, but just seems a little bit over their skis, right? That maybe we want to make sure we're diversified outside of some of that traditional AI.
Well, two of the Mag 7 were only beat the S&P last year. The other ones did not.
Isn't that
They're
crazy?
certainly not beating it this year.
Yeah.
So to your point, there's other areas of the market that could do quite well in spite of what the Mag 7 did.
Yeah. Cool. Let's talk a little bit about GDP and the economy. And this, some of the conversations I've been having it's so interesting to, and I don't know if you interface with the ultimate retail investor the same way that advisors do. I know you interface a lot with advisors, but we're obviously interfacing with the end user. And it's interesting to have conversations with them about the stock market and about their portfolios. And there has been an increased amount of, I'm going to say, anxiety with the retail investor in my experience. And maybe it's because it just seems like the world's on fire. It just seems like there's anytime you turn the news on, like the news, oh my gosh, right? You get exhausted trying to keep up with everything. But there seems to be like an increased level of anxiety with some end user and retail investors. And it doesn't necessarily, and then you look at the news, right? The distraction and all the noise and stuff that's happening in the news. And then you kind of look at the economy, like the metrics, and nothing seems to be aligning. It all just seems to be, everyone seems to be like in like a separate world. How do you reconcile all that, and what does that tell us about the market for 2026?
Finance 101 lesson number 1: never panic based on a headline. Headlines, and whether it's a war, a tariff announcement, a State of the Union, whether you agree or disagree, rarely have anything to do with markets. The stock market is really separate from what the broad-based economy is doing. Now, we care about the economy because as the economy goes, eventually the market might go, but it's really critical to never panic. When you see a headline like, unfortunately, Russia invaded Ukraine now 5 years ago, it's hard to believe how much time has passed. But when you see these headlines, or Israel and what's happening with Hamas in Palestine, or the potential for the United States to maybe bomb Iran, I mean, it seems like that's a daily increasing possibility. Why these headlines generally don't tie to economics? Because At the end of the day, the horsepower of the U.S. economy is us, the average U.S. American, who spends 70% of of U.S. GDP. U.S. growth is based on what we spend, and the average consumer today is in excellent shape. And the reason why is we have full employment, we have relatively low interest rates. We had an inflation spike, but now they're back to normal. We have wages have been above the rate of inflation for some time, and U.S. GDP for the third quarter of last year was over 4.5%. In the second quarter, because of the government shutdown, came in at 1.4, but probably was more like 2.5. You have a scenario where U.S. economics are really quite good, and when you look at the headline, they don't seem to correlate. Tariffs is a great example. The average person felt probably $400 or $500 more last year because of tariffs, but their wages were higher, and they just got a big tax break on January 1st. And oh, by the way, gasoline's down probably $1 or depending on where you live. So when you look at the real facts, the headlines don't really tell you the story of what's happening under the U.S. economy.
Yeah, that's I was going to ask about the tax changes this year. With that everything seems to balance out at the end of the day, but it seems to be and I guess this is a very human thing, right? We latch on to certain things that seem to stoke some type of really strong emotion in us, and we kind of latch on to that. Like, it's bad news because there's a AI arm flipping hamburgers in White Castle, and they're coming for my job, and all of a sudden it feels scary. And
some of that's reality, Eric. To your point, there are jobs that are going to be lost. We've watched first rung of the workforce jobs since 1971, which used to be 43% of the U.S. economy. Today are about 21, probably going to 15. So the kid flipping fries in White Castle isn't doing that anymore. But what new industry is created in spite of that, whether it's the regulation, the building of the data center, the controlling of the data, and so on. But to your point, you said something spot on, which is what is important to me that has me worried about the U.S. economy, what headline. And that's critical while you take on Eric or someone like me that helps Eric from time to time manage money, is that we don't let the market's headlines or the economy's headlines affect the ability to staying invested, look for opportunities, and focus on the long term. They're two very different things, and a lot of folks make that mistake.
Yeah, I had a client call the other day, and this is a new successful individual, small business owner, okay? Creative. He's got a couple different businesses, and he's doing some really cool stuff, brand new to the market, mid-30s, just has really the ability to build a lot of wealth, but kind of real skeptical of the market. And we've been working together for a little over a year. And I'm always a little bit hesitant because I don't want new people to the stock market to have a bad experience with the stock market too early, right? I want them to become a little bit comfortable because I don't want them to get jaded, because I know that this is a way for people to build wealth over the long term. And and he booked me for a 15-minute call earlier this week just to really hey, look, the world's on fire. Like, what should we be doing? Should we be changing things? What should we be doing? And his portfolio is invested for the long term. So we talked through it, and I think that is a role that the advisor, if I'm gonna tell you, if you're listening to this and you do not have that relationship with your advisor, where your advisor can have these conversations that can talk reality or talk rationally about what's happening in the market and the impact of the importance of having a portfolio built for the long term, you need to be having those conversations, because your ability to build wealth in the stock market is contingent upon you being invested in the stock market for the long term, right? And if you get spooked out because of the headlines, and there's always headlines, it's amazing. This is a project for you. You got a research team. I got a project for you. I started this a long time ago, and I just didn't have the discipline to stick to it. Find the leading headline for every single day, okay? Whatever the leading headline is, positive or negative, the one that gets the most traction. I don't know how you would measure that. And then measure what the market did that day, and just do that over a period of time. And it'd just be really interesting for me to see the market not. You have it. Look at this.
Don't panic.
Don't panic.
It's a fun book about how in every single decade there has been multiple reasons to panic.
Is that a picture book?
Every single decade, the stock market went up.
Is that a picture book?
It is a picture book. Actually, a friend of mine, to your credit.
Oh my gosh.
So you can go through and you see is, there's always been some reason. Worst day of the U.S. stock market ever, and this is 1987 crash.
Yeah.
And you go through, and then whether it's the 9/11 event, the tragedy in Oklahoma, there's always been some reason to panic about what's happening in the markets. And yet markets have every single decade have had a seminal moment. By the way, we just had one. Remember what happened in 2020? We had a global pandemic. And what did the market do that year? It finished up 22%,
right?
not down.
That's
So you don't have to go further than that. There's your living color. And that's why you want someone who's going to be disciplined. While I agree, growing old is mandatory, growing up is optional. It doesn't mean we don't focus on the facts and do what's right about markets, which is we know over time, as long as we're not in a scenario where we get a fundamental break, a course correction in U.S. economics, you're going to make money in the capitalistic system. You're going to make money based on capital.
My favorite chart of all time, if this was the only chart I ever could use with clients, is the one that shows year by year, inter-year drawbacks, and then final year returns.
Yep.
Right. I mean, COVID, we had like I think a pretty quick 30. We dropped 30% maybe somewhere around there in a matter of
peak to trough. Yep.
Still
That's
ended
exactly
up.
Right.
The tariff tantrum last year, we dropped. I think we had like 10% swings.
17% peak to trough
in a day.
Yeah.
Right. We still ended strong, so we can't be spooked. And that's if you pull anything away from this podcast, y'all, stay invested. Invest in good companies, be diversified, and stay invested. If you're not in small cap or large cap, you don't have the right percentage, the right out. You will make money if you stay the course over time.
Being diversified, you said it. The market's never lost money in a 10-year period, or put a different way, the equity market 3 out of every 4 years is up. It's just that simple. Now, what I want you to take away to Erik's point, we have had the last 10 years of super returns, unusually high returns. That's a combination of what AI did to drive revenues higher, but only for a portion of the market. And the other thing is the federal government printing $22 trillion since 2008. And that amount of money had to go somewhere. It went into the stock market, went into the bond market, went into the housing market, went to your used cars. People who have hard assets are up probably 3 times what they probably normally would have been if that had not happened. Yeah. Okay, so that's okay. But now we're on the other side of this. It means more prudent federal government management. It does mean more average stock market returns of 8%, not 12 to 13. So what are you doing that? Erik hit on it. Be diversified. Own bonds. Own other things that can drive real return in your portfolio besides the Mag 7.
But before we're going to get to international and bonds here real quick, but I'm curious to get your perspective on something. I know on your podcast, you talk a lot about your daughter, Luca.
Yeah.
Georgia Bulldogs.
Yeah.
Right. That Sugar Bowl was wild, man.
I was there.
Oh my God, that Sugar Bowl was wild. My daughter is 19 and she's in New Jersey in Rutgers, freezing her tail off right now, buried in snow.
We are. I have 2 feet of snow in my backyard right now. Whew. I had to plow the backyard so the dogs have somewhere to run.
Man, I sent her 2 king cakes during Mardi Gras, so she shared with all her Jersey friends. So
nice. I got to get one of those.
Man, they call her Louisiana up there. I think she loves it. But it's interesting. I have conversations with her about AI, and I'm curious if this is your experience with your daughters when you talk to young people. My daughter has almost this negative reaction towards AI. Like, Dad, I don't want to use it because I see my friends using it and I can see how it makes them not think. It makes them, I mean, they're just, they can't even do simple math. They use AI to do math. And then the environmental impact, like, oh my gosh, this is not good. The amount of energy and whatnot. Are you hearing that from young people? Do you see that? And as I think about it, I'm like, I wonder, like, if she's representative of her cohort of friends, or that cohort, that generation. You kind of think about that as these, as we go through decades of generations, and what impact does that have on these industries?
Well, and that goes back to an earlier comment. I think she's the exception, not the rule right now. But the reason why is because we have no choice but to use it. For example, let me go back one further. My kids, and they're 2 young ladies, both at the University of Georgia, good kids. I'll give you a good example. The younger one's better than the older one. Very often, they're going to jump in their car, and what's the first thing that they do? They plug in their GPS to tell them where to go. So we had a conversation about this about a year ago. I said, Girls, you got to stop doing this. You got to be able to learn to drive where you're going without having to plug it into your phone. If you got a long drive, you want to check the traffic, I get it. But something short around town, they have friends that literally can't get across town without looking on the GPS where to go. And I think that's what caused some of this. So whether it's kids that unfortunately are using it instead of using their brain is very dangerous, because we get to a scenario where, think of the disruption in the industry of psychology, where if you're using an AI bot to have it instead of a psychologist, where does your brain switch off? To the Pope's credit, just yesterday the Pope came out and said, and I'm not trying to be religious here, I am a Catholic kid from Jersey, so forgive me, but the Pope came out and said he does not want any of his priests using AI to ever create a sermon or a homily. Why? Because it has to be a human, not a machine. On the counter argument, what if the machine is referencing thousands of literary books over the ages that could pull really thought-provoking homilies versus maybe a boring one that a person might create? So where's that balance between the two? I think it clearly is, to your daughter's credit, using it as a tool to sharpen your personal perspective. That's where we end up, great.
Yeah.
But if we use it to become lazy, then it's very dangerous. Because you know what happens in that? We will get manipulated by people who use it to their advantage.
Yeah.
The wolf and sheep analogy. The wolves are always going to use something to win, and the sheep are going to accept what's in front of them. And that does have me a bit worried.
Actually, I actually wrote her a letter about that specific thing. It's kind of something I'm trying to do. I'm trying to write my kids more like physical letters, like
I like that.
handwriting. And I talked about AI and about how in my space, the people who I see using it successfully already are really good at their craft. They're already top of their game. And this is just making them more effective, more efficient. Anyway,
That's a great point.
So I was curious to hear your thoughts and what your kid's response was. Let's talk about international.
By the way, I'll add my own daughter,
Yeah.
my younger daughter, who's in the medical program at Georgia, refuses to use it.
Yeah.
Because she doesn't want to be in a scenario where she would hurt somebody someday because she cheated. So interesting perspective.
Yeah. I actually have a good friend of mine. He directs the Center of Entrepreneurship at the University of Tulane. He just taught a class with another friend who is in the engineering department, and the class is based off of a course that was created by the Yale Divinity School, and it's about tech ethics. So they talk about healthcare, they talk about AI, they talk about the environment, because they're raising up the next generation of entrepreneurs, and these kids are going to be faced with ethical decisions on how they move forward with these
Fascinating
business. So it's really, I'll send you a link to. I had them on the podcast. I'll send you a link to listen.
I like to listen, yeah.
But it is a fascinating course. They gave me the coursework. There was, I'll tell you this, and then we'll talk about international. One of the classes they talked about was on, and what's really interesting is they talk about like the existential stuff of life, suffering, and faith. And it's not faith specific. I mean, they're reading. I mean, they have the Bible, the Quran, the Jewish teachings. I mean, it's a pretty broad kind of a curriculum. But one of the courses was on giving, and the assignment was go read some of the giving pledges from the Gates Foundation and Warren Buffett that they started, because what is it? Billionaires giving away half of their estate. Go read a bunch of them. Which ones resonate with you, and then you write your own giving pledge as though you are in that position to give. So I took on the challenge as a student, just out of curiosity.
I think that's cool.
It's a really cool course. International for so long was just kind of like ho hum, right? And then last year, woo, man, if you weren't international, you just underperformed. How long does this continue?
That's a really good question. And we were late to international because it was a trade, not a trend. On Liberation Day, the dollar sold off by 10%, boosting international by 10%, and then winning on the year by about 13%. And the reason why is countries like Germany have committed to spending something like $600 to $1 trillion, $600 billion to $1 trillion on defense spending. And much of that will be spent intra-Europe and in the United States. So what happened is sort of what we went through, which is stimulus scenario is driving the opportunity in Europe, but that's not a permanent scenario. So I think you got an opportunity because, one, those stocks have been cheaper. We haven't owned international for the better part of a decade. Right. Now we do own some. We're increasing our allocation there only because we're seeing finally some revenue growth with around 9 to 10% revenue growth. Stock price is a bit cheaper. I use the analogy, you walk into a grocery store and the most expensive cereal box on top is just gotten too expensive for you. You don't want to own it. That's the Mag 7. What might you want to own? Something else that you still tastes pretty good, but maybe it's half the price. That's international. A cereal box on a shelf down or two. Mm-hmm. So what's happened there is the prices of the stocks are fair. We're finally seeing some growth. A lot of it's due to government stimulus. unfortunately, they're an overregulated continent that just can't get out of their own way. So I don't think it's a permanent solution, but I think temporarily for the next couple of years, it's a way to add value to your portfolio, get return, but also be diversified. If U.S. markets sell off, international tends to sell off too, but not nearly as much. And that's a way to limit some of the volatility and risk in your portfolio.
Okay, cool. Let's talk about the sexiness of bonds, Phil.
Love them.
Are we like bonds are another one? For the better part of my career, bonds were just kind of like, right? I mean, with rates as low as they were, and then the rates increase, like where, talk to us. Why are bonds sexy, man? Because when you run any portfolio, historical portfolio, and then you throw bonds in there, and you're like, I don't want this in my portfolio, right?
It's because you haven't had a real stock market correction that lasted other than 2023 in a long time. So one, they're insurance. They do go up when markets go down, like they did in 23, temporarily, and then they got murdered. Separate conversation. They got murdered because it was a really significant inflation scare, and the Fed started raising rates. But in a normal environment, they're insurance. But why I like them right now is you're getting a 5% yield, 4 to 5% yield, depending on what you're buying, and inflation's at 3%. Anytime you're buying a safe asset and you're beating the rate of inflation, one of two things happen. One, you're making money every single day. And two, interest rates eventually go lower to match inflation. And when yields go lower, prices of bonds go higher. For example, this year, the bond market's up about 1.5%, and the stock market's up about 1.5%. So here we are at the end of February, and being in bonds is as sexy as being in stocks. In fact, more so. Why? You haven't had these bouts of volatility in the bond market that you had in the stock market. So it does, I love them because it gets you real return, real income in your portfolio. It gives you safety and security, and maybe a chance to see them go up as much as 7 or 8% this year, like they did last year. The bond market was up a whopping 8% last year. So that's a pretty solid number. And if you do that at a time when the stock market does 8, then your balanced account will beat the S&P 500. Year to date, a balanced account we manage is up about 3% when the S&P is only up about 1.4%. So that's kind of cool. Well, largely because of bonds.
You kind of opened this conversation with return to normalcy. This is what is more normal with bonds, correct?
Yep, emblematic of where bonds are. That bonds historically. Now, granted, let's be careful. In 1980, when interest rates were 15%, and they took 40 years to go back down to 1% on the 10-year, you made money every single time rates went down and yields went higher. We're not in that kind of environment. But when the Federal Reserve actively to a degree cutting interest rates, and I do think we get a couple of cuts this year, maybe at least one, well, that's an environment where inflation and yields are going lower, so you get prices going higher, and it becomes a nice anchor in your portfolio. So it's not the double-digit returns of the past, but a nice 5 to 6%, maybe 7% rate of return on a bond portfolio that has very little risk. It's a great way to prevent you from panicking, by the way, but also taking advantage of what the market's giving you.
Yeah, interesting.
Being paid to wait around to a degree.
Being paid to wait around. I get paid to wait. It's like those guys who stand in line for new iPhones. Or Mardi Gras, sometimes people will pay people to sleep out on the neutral ground, which is the ground between the streets. We call it the neutral ground. Y'all call it the median, I think.
Yeah.
People will pay people to wait for the parade to come around, save their spot. What scenario keeps you up at night?
That's a really easy answer, and it all feeds back to the same thing. If we happen to be in a scenario where the interest rate policy has to change because inflation goes higher, everything gets murdered. The bond market, the stock market, even international. And the reason why it would go higher is predominantly because around the globe and in the United States, there's just too much debt. We cannot get our debt under control, whether us or rest. For example, Eric, for every $5 of American revenue today, annual just tax revenue comes in, $1 goes to making interest rates payments on our debt. And it's the same for much of the rest of the world. So we're just awash in debt, more so than we've really ever been in American history other than after World War II. So you either get U.S. GDP to grow fast enough to go to a balanced budget, or you start to look like places like Japan, that for every dollar they make, they owe $2. Europe, for every dollar they make, they owe $1.50. Today, for every dollar we make, we owe about $1.05. That's not healthy. So in a scenario where the rest of the world doesn't want American bonds because we have too much of it and interest rates have to push higher to get them make them more attractive, that's a problem. And that's your number one black swan today. And then the second one that goes with it is, and correlated, not exactly the same. We have $10 trillion that's going to get refinanced this year. Bonds coming due, they get reissued. If we have to continue to issue them at a higher rate, there's just not enough spending by the federal government that can do to stimulate the U.S. economy if things go badly. So it's all kind of connected. I jokingly call this Dante's Inferno, that we're in level 1 of hell. And you've got to, before you spiral down to 2 and 3, you have to get your fiscal house in order. So those are the first two that bug me. And then the third one that keeps me up a bit is this, what does AI ultimately mean? If we do get rampant destruction of major companies, IBM got pummeled the other day because they're not keeping up in the AI race, then we have a scenario where a handful of companies create a very concentrated market and there's more losers there on winners. That's a very tough market to make money in. Another reason why I like bonds, by the way. So those are the kind of things that keep me up at night. It's not economics in the United States. It's not wages. It's not inflation. It's not a recession. It's none of those things. It's not where we're at today. There's a K-shaped economy, whereas most of the United States, the top, people over the age of 60 and older own today 72% of American assets. They have all the wealth of the country, but the boomers are not going to live forever, and that generational wealth will transfer from one to the next, creating an economic boom 15 years from now. But today it means people who make less than $100,000 a year just kind of hanging on. Some of those things worry me, but they're not destructive. They're just not great. They're not destructive.
If you're wrong about one major theme that we talked about on this podcast, which is the one that you think is most likely to disappoint?
Diversification. That I believe being diversified is going to be better than being concentrated in just 7 stocks. The last 10 years have really been about being in mostly just those 7 stocks. Yep. And that could continue if the AI revolution, industrial revolution continues at rampant pace and nothing else wins but those 7, then much of what we talked about will be irrelevant. I don't think that's the case based on what happened last year in living color and then what's happening so far this year. But it could be that the stocks have sold off for no good reason, and suddenly the whole world wants to own just these handful of names, and nothing else matters in the market. By the way, if that happens, the beauty of what you and I do, we could pivot back to being concentrated in those names again. I don't like it because it's much risky, but if that's the case, we never fall in love with the thesis. The thesis today suggests that we're going to go where the puck is going, but if the puck shifts direction and goes a different way, then we change. So it's never that we can't make you money. We just think that the market shifted from where it's been over the last few years.
Yeah, that's good stuff, man. I'm gonna leave you with the last word. Any closing thoughts? Anything? Any rock that we didn't turn over that we need to turn over, Phil, before we end this?
Yeah, I think there's something phenomenal, a phenomenon that's happening in our ecosystem of labor/immigration, and right now, what's happening is there's a shift from jobs that maybe weren't as productive to hopefully jobs that are going to be more productive. And that's going to be tough to watch. So you're going to have folks who are struggling to see, hey, I lost my job because of AI and I haven't found one yet, but eventually they will. So don't panic about that. But that's going to be a fascinating moment in time. But then the second piece about that, which I think is fundamental, is how does AI make us more productive? And I'll put it to you this way. If you have a job and you do 40 hours a week and AI gives you back 4 or 5 hours of time because you're better at your job, do you use that to make more money for the company or for yourself? Would you use that for leisure or a combination of both? Yeah. So I think one of the fun things I'm watching from the outside in is what's the impact to all of us on AI and what does it mean for how we live and breathe, but also how productive we are. All those two things together tell me that I'm very optimistic about where we ultimately go because of the benefits we'll get from AI. And my hope is that demographics continue to reflect growth and not contraction. By that, I mean, you can't have a really great economy, even with AI, without a growing population. So I'm hoping that we can figure out how to stimulate that. And I'll translate a different way. Will younger generations have more babies because AI has made them more effective and they have more free time and maybe more money? And hopefully we get immigration worked out.
More free time means we're spending more, which means we drive the economy. That reminds me of speaking of fun. We'll kind of end where we started. Do you remember the market update? What you call market update that you and Jamie did at conference?
Yeah, we did one together. Yeah,
I was backstage because I was actually going to go. I was going to speak after you about that exact question about using AI in additional productivity. And the question was that question in a couple other conversations. Question was, how much more productive have you been with your with the additional productivity that you've been gifted because of using AI. And that conversation was specific about an AI note taker. And my response was, I really don't track that. Like, I get to go coach my daughter's basketball team.
Yeah.
I get to spend time podcasting, having interesting conversations with people. Like, I'm not necessarily using AI to be able to go produce more. And I think that's the myth of AI, that we just want to more and more and more and more. That just leads to this like rat race where you can't have fun, man. You know, one of my
Hopefully
best
it enhances
friends,
our lives and we can be better at our job and enjoy ourselves more coaching basketball. I think that's brilliant and spot on.
I joke, one of my friends, he's a family therapist, and he's a guy who really values leisure. So a couple years ago, it was it wasn't a resolution, but it was like, hey, you're going to be my leisure coach, right? So I joke that he's my leisure coach. So that's what I want to do with my additional productivity. I want to do more leisure, and I guess I'm driving the economy because I'm spending more money.
I love it. That's what we need you to do. And have more babies. Want to have some more kids. You're not that old.
We're going to end on that note. No more kids. Bill, man, I always appreciate your time, and I'm looking forward. I think we'll see each other sometime in April, probably in person, hopefully.
Thank you for having me on. It's always an honor and a pleasure. I enjoy our conversations. You're a brilliant guy and a great advisor, and it really is an honor to be on.
Awesome, man. Appreciate you. Take care.
See ya.